session now?
No, you stay here.
No, we stay here.
Okay, welcome everybody to this webinar run by CEBRA and the Center for Inflation Research at the Cleveland Fed. My name is Raphael Schönle. Dominic Smith is my co-organizer, and we have two speakers here today. One is Stefan Nagel, and the other one who is going to be joining us is Jonathon Hazell. Stefan is a distinguished professor at the University of Chicago. Jonathon Hazell is at the London School of Economics. And the usual disclaimer applies. This is all the views here are solely those of the authors and none of the affiliated institutions, the Federal Reserve System. I think we are, I should also say, I'm sorry, I probably took some of your notes, right? Our organizer today, moderator today is Hugh Montag. Hugh, if I forgot any of this off the top of my head, please compliment it. Otherwise, I'll hand it over to you.
Yeah, thank you, and no problem. So the two papers for today's session are Learning Against Inflation Experiences and Do Deficits Cause Inflation? A High-Frequency Narrative Approach. The webinar is going to be 45 minutes. Hopefully we'll have two presentations that are 15 minutes each, although it's possible we might only have one longer presentation. We will have 10 to 15 minutes for questions and answers at the end. Attendees do not have the option to turn on their audio and video, but they are invited to write comments or questions in the Q&A space. Attendees can post their questions during the presentations, and they don't have to wait until the end of the presentation to do so. And then during the Q&A portion, I will select questions to be answered from that by the presenters. This webinar is being live streamed on the CEBRA YouTube channel, and it's also being recorded and will be made available on the CEBRA website at cebra.org and the CEBRA YouTube channel after the event. And then lastly, the more formal disclaimer: participation in the CEBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of the views, opinions, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a CEBRA or CEBRA co-hosted event are strictly those of the authors, discussants, and other participants, and not those of CEBRA, the co-sponsoring institutions, or any other participating institutions. Thank you, Raphael. And without further ado, Professor Nagel's presenting Leaning Against Inflation Experiences. Professor.
You see the slides?
Yes.
Sorry.
Perfect.
Okay, thanks a lot for having me here. So what I'm going to talk about today is about trying to understand secular dynamics in real interest rates. So focusing on the very long run patterns in real interest rates in the US, but also internationally. And one big fact is that in many countries, we have seen a rise in real interest rates over several decades into the early 1980s, and then a multi-decade decline after that. And it's important to understand why, what is driving this. And one set of explanations focuses on the natural rate of interest, or R star, to explain, through demographics, productivity, and other forces, why real interest rates might change. The red line in this chart shows you a very popular estimate from Laubach and Williams for this R star rate. And the one takeaway from this is, R star has maybe some connection to the secular dynamics, but there's a lot of stuff, even in these slow moving changes, that is unexplained by R star. And what I'm going to argue today is that some of this movement in real interest rates that is not explained by R star has to do with long-term inflation expectations. And I'm going to explain why. The story basically involves three elements. The first one is that when people form expectations about future inflation, they rely a lot on their experiences in the past and not much on the words of central bankers. So unlike in a rational expectations model with commitment, where a central banker could change long-term expectations just through words, in my kind of model, it's going to be the experiences people have with actual inflation that are going to lead them to form expectations about future inflation. The second part then is that if these experience-based long-run inflation expectations deviate from where central bankers would like the expectations to be, the monetary policy will have to lean against these experience-based long-run inflation expectations, and that's going to lead to a persistent real interest rate effect. And the third element is that because agents think they are, learning as good as they can from past experience data, they don't anticipate that the monetary policy leaning against inflation expectations effect will actually change anything in the long run, because they basically think of their own inflation expectations as what the central bank is presumably aiming for. And so I'm going to show you several pieces to basically that are supporting the story. So the first one is going to look back at my earlier work with Ulrike Malmendier and show you an update on how inflation expectations are formed based on the Michigan Survey of Consumers. That updating scheme that comes out of this is basically the underlying updating scheme that I use in my model, which is then the second part. A model, a New Keynesian model where monetary policy leans against long-run inflation expectations that are experience-based, and then some empirical evidence that there's actually indeed a connection of real interest rate dynamics with long-run inflation expectations. The paper also has international evidence. Today, I'm going to focus just on evidence from the US. All right, so first on the expectations formation mechanism, an update of my earlier work with Ulrike Malmendier. And in that work, we look at, we start with a setting where we assume that consumers are forming inflation expectations with a perceived law of motion in their minds that's an AR1. And they're trying to estimate basically the long run mean of inflation, and they're trying to estimate the degree of persistence of inflation. And they do so with least squares learning. These are the updating scheme equations from a least squares learning scheme. But the important thing is that different cohorts focus on the data from their experience during their lifetimes. And then within their lifetimes, cohorts weight recent data a bit more than older data. And in our earlier work, we estimated this weighting scheme, or how much earlier, more recent data gets weighted more than data earlier in life. And we obtain a parameter that controls this weighting, which is this theta parameter that took a value of about 3. What this means is that when people form expectations about future inflation, they look back at their lifetime data set, and you can think of the half-life of their memory as being something around 15 years. This is what this parameter estimate basically implies. Now let me show you an update of this. So this is now data from the Michigan Survey of Consumers. The dots show you the actual data. The lines are the fitted values from this learning from experience model based on this AR1 process and learning from lifetime experiences. And everything is plotted relative to the cross-sectional mean. So if you see something showing up above 0, this means this is now a cohort that has, or a group of cohorts that has above average inflation expectations at that time. If it's below 0, these are then groups of cohorts that have below average inflation expectations. Yeah, just looking broadly at the patterns, what you see is there's a gap opening up in the 1970s between young and old. And by 1981, the young people, those in black, had about 3 percentage points higher inflation expectations than older people, which is consistent with this idea that young people's experience played a big role here. Their young people's experience was dominated by the experiences of the 70s, while older people still look back to the 50s and 60s when inflation was not so high. And then this gap between young and old closed. In the 2000s, it actually flipped around. So by then, it was older people that had higher inflation expectations than younger people. Again, consistent with experience-based learning, because older people at the time still had the memories of the 70s, which younger people did not have. And then everything to the right of the dashed line is basically now an out-of-sample analysis that goes beyond our original sample. And you can see that these patterns that are experience related also carry on in that out-of-sample period. And so this is now this experience-based expectations formation mechanism is not what I now use as the base for thinking about real interest rate dynamics. And I'm going to simplify now in a number of dimensions, because I want to focus, first of all, not on cross-cohort differences, but on something resembling a representative agent. And second, I want to focus on secular dynamics, not on shorter run dynamics. And so I'm not going to think about cohorts learning from experience, but we're going to look at what, in some sense, the average agent is doing and how the average agent forms beliefs. And the second point is I'm going to focus on long-term inflation expectations. And Ulrike and I, in our earlier paper, had already shown that once you consider the average belief across cohorts, the dynamics of the average belief actually becomes very simple. Because it becomes a constant gain learning mechanism. Even though every cohort learns with decreasing gain, once you average across cohort, you basically get a constant gain updating scheme. And in particular, for long-run inflation expectations, this then gets a very simple updating scheme, becomes a very simple updating scheme where basically the most recent inflation rate is averaged with the belief from the last period. And our microdata-based estimates from the Michigan Survey of Consumers basically imply a value for what that weighting coefficient should be. That's actually not going to play an important role in what I'm going to do, because I'm going to fix in the updating scheme that I'm going to use for the rest of the analysis, I'm going to fix this parameter phi to exactly this value that we obtained from the microdata. So I'm not going to use it to better match the real interest rate dynamics. I'm going to tie my hands to that value that's implied by the microdata. And it's quite an important parameter because that one determines how fast these expectations are moving over time. If you have a phi that's very big, you would have expectations that move very quickly, and so that's quite important. All right, so a brief look at the new Keynesian model. It basically has several equations that are quite standard, but with a little tweak. The first tweak is on expectations. The expectations formation mechanism for long-run inflation expectations is basically what I just outlined, this constant gain updating scheme. And then there's a Phillips curve where inflation expectations basically feed into current inflation. There's a discounted Euler equation. It's discounted to not run into forward guidance puzzle type issues. And then importantly, there's a monetary policy rule where monetary policymakers basically have a forward-looking rule where they care about inflation expectations. And in this model here, the only inflation expectations that matter is long-term inflation expectations. And so monetary policy leans against long-run inflation expectations if they deviate from the target where central bank would like inflation to be. And so let me show you how this kind of plays out. Here's a quantitative analysis that's meant to, in a stylized way, to represent what happened in the 1970s, where the dashed line shows you some cost push shocks that hit the economy for a number of periods at first. So think of this as the 1970s. And then the blue line is the inflation rate that results from that. It actually goes up a bit more than what these cost push shocks induce on their own. And that's because once inflation was high, this now gets to the yellow line. Once inflation was high, it starts to produce higher inflation expectations in the future through this experience-based learning mechanism. And this then also contributes to raising inflation through the Phillips curve. And the way the central bank reacts to this in this model is that here the yellow line is again the same inflation expectations, long-run inflation expectations as in the previous plot. The way the central bank reacts to this is when the higher subjective inflation expectations are, the higher they want to have the real rate because they want to engineer lower inflation to get these long-run inflation expectations back down. Yeah, and so what we then see is a strong co-movement between the real rate, which is shown here in blue, with these long-term inflation expectations that are shown in yellow. And this is basically what I'm going to look for in the data. Is it true in the data that real rates and long-term inflation expectations are so closely connected? Okay, so here's the data I'm going to work with. These are several series of real interest rates. These ones at a one-year horizon. So black dashed line is an ex-post real rate, just subtracting the realized inflation rate from bond yields. And then the other one, red and blue, are subjective real interest rates by basically taking a bond yield, a nominal bond yield, and subtracting an inflation expectation from either households for the red series or professional forecasters for the blue series. And then the black line is this perceived long-run inflation that comes out of this experience-based model based on this parameter, as I said earlier, that we obtained from the microdata. And the key thing now is basically econometrically looking for connections between the black line and these series of real interest rates. But before I show you how I do this, first one more chart with data. This is now the whole term structure of ex ante real rates for households. So based on household inflation expectations. And one really important striking fact is that in the early 1980s, as you can see here, not only were short-term real interest rates high, but long-term real interest rates were very high as well. And as I explain in more detail in the paper, this model I have outlined can actually explain this, that the whole term structure of real rates at the time was elevated, not just short-term real rates. All right, now let me show you some estimates. So what I'm basically interested in is estimating something like this, where you put a real interest rate on the left-hand side and you regress it on some measure of these long-term inflation expectations on the right-hand side. And of course, there's an issue here because these series are highly persistent. There could be units roots, there could be co-integration. Maybe there's no co-integration, we don't quite know. And so the estimates in the paper are based on estimating an error correction model and then doing a test that is valid basically even in the presence of unit roots and co-integration or no co-integration and so forth. And all of the estimates are going to show you that basically pass this test, that there is actually a long-term relationship even under these conditions, that there could be unit roots and so forth. Yeah? So a long-term relationship between the left-hand side variable and between this inflation expectations on the right-hand side. And so let me show you some estimates. This is putting realized real rates on the left-hand side for different maturities. So 3 months in blue, 1 year in red, and then green is a 7-year forward realized real rate. And they are now regressed on this experience-based long-term inflation expectation series. And the coefficient magnitude tells you for 1 percentage point move in long-term expected inflation, how much do real rates move? And you can see it's a coefficient of about 1.5 for the shorter maturities. So 1 percentage points higher inflation expectations in the long run means 1.5 percentage points higher real rates. Here's the same thing with subjective real rates using household inflation expectations subtracted from bond yields. And there you see, again, coefficients with magnitude of around 1.5. And it's very much the same across the whole term structure. And this model that I outlined earlier predicts exactly that for subjective real rates, you should find that the whole term structure moves up and down, basically level shifts with long-term inflation expectations.
Okay, 1 minute left.
Yep, sounds good. And so just to show you graphically how what this contributes in terms of explanatory power, this is a series of 5-year real rates based on household inflation expectations. The red line shows you R star again, and the blue line shows you what's explained basically by this inflation expectation component that I was trying to contribute here or understand, in addition to R star. So basically adding this over and above R star. And so you can see the blue line does a lot better in explaining the actual real rate series that we see in the data. All right, there's international evidence as well. I'm going to jump into this. Also, the story or the model explains a whole bunch of other facts about the co-movement of nominal rates with real rates and a whole bunch of other things. The paper has more details on this. But in the interest of time, I'm going to wrap this up here. So the one important point to take away is that the evidence here shows that through this leaning against inflation experiences channel, monetary policy has a substantial, very persistent effect on real rates. And so even if one focuses on just secular long-term changes in real rates, one shouldn't necessarily assume that this is all about the natural rate. Inflation expectations can actually contribute quite a lot also to these secular dynamics of real rates. If you think about what this model that I work with here implies, is it also has something to say about how easy and how difficult is central bankers' jobs of keeping inflation under control. The model I worked with here implies that once long-run inflation expectations are elevated, it's actually very hard to bring them down. It requires an extended period of high real rates, kind of like in the early 1980s, to bring inflation back down. This is, in some sense, the opposite view of Sargent, where he said, well, policy could just reset expectations after hyperinflation. But I don't think there's really a contradiction, because Sargent was looking at cases where there was a drastic fiscal policy regime change, and something like this could, of course, reset expectations, while my analysis is basically done in a setting where there's no drastic regime change, but we are kind of looking at a more normal policy environment. Yeah, and so the bottom line is monetary policy matters more for secular dynamics of real rates than is commonly believed.
Okay, great. Thank you. We're going to move on to our next presenter now. Professor Hazell will be presenting Do Deficits Cause Inflation? A High-Frequency Narrative Approach. And Professor, if you can share your screen.
Yeah,
the time is yours.
You can hear me?
Yes, I can hear you.
Excellent. You can see my screen?
Yes. Perfect. Yes.
Perfect. Okay. Thanks a lot. Thanks so much for the invitation. It's great to be here. This paper is called The Deficits Cause Inflation, a High-Frequency Narrative Approach. It's joint work with Stefan Nagel, who's a great PhD student at LSE. And the question is, do deficits cause inflation? It's a topical question, also a classic one, but it's topical because fiscal stimulus has been quite large recently, 13% of US GDP in December 2020 and March 2021. And inflation has subsequently gone up by a lot, as much as 8%. But there's an empirical debate. Some are arguing deficits were important for the 2020s inflation. Others say deficits weren't so important. And ultimately, it's an empirical challenge. We've got the usual emitted variables concern. There were other potentially inflationary shocks, oil supply shocks, pandemic. It's going to be difficult to disentangle the effects of these from the effects of the fiscal policy. And it's especially difficult because we're thinking about a single influential episode. Many shocks are happening during this episode. Disentangling the effect of any individual shock is going to be difficult. On the other hand, of course, single episodes are very influential for macro theories. If you think about the Great Depression, the 60s to 80s inflation, or the post-pandemic period, these are really shaping our thinking. What we're going to try and do is introduce a high-frequency narrative approach to try and figure out the causal effect of deficits on inflation. We'll have a narrative measure of the shock in the spirit of Friedman and Schwartz. We'll study the high-frequency response of asset prices. The advantage, as will become clear, is one can estimate the effect of single episode-specific shocks. Okay, so here's the event. 2 Republicans and 2 Democrats faced off in the 2021 Georgia Senate election runoffs. To remind you of what happened, in November 2020, Democrats won the presidency and they had 48 Senate seats. On January 5th, 2021, there was a runoff election for 2 senators from Georgia. If Democrats were to win both, they'd have a majority in the Senate for fiscal stimulus, but there'd be a small difference for non-fiscal. In the event Democrats did win, that was news about deficits. So the question is, how much news about deficits? And to figure this out, we're going to come up with a narrative measure of the shock, a narrative measure of the deficit news from Georgia. So to do so, we'll come up with hand-collected data, time-stamped information from 20 investment banks. We'll read off the investment bank reports that there's a probability of 50% of the Democrats win. If they win, they'll spend about $900 billion of stimulus, of which 70% will be transfers and deficit finance. That's going to be a $450 billion or 2.1% of GDP shock to deficit news. And in the reports, we'll read that the main consequence of Democrat victory was fiscal stimulus. Then we'll look at the high-frequency response of inflation expectations from intraday swap prices. Mostly we'll be looking at a single event study around the election. The advantage is it's going to exclude lower frequency emitted variables. So the potentially confounding effects of the oil supply shocks, the bottlenecks that we were worrying about, they won't matter unless their news coincides with the election itself. In the event, we'll find a 40 basis point increase in the expected price level over 2 years. In terms of robustness, the main potential confounder is the Capitol Hill riots, but we're not too worried about that. And I'll tell you why later on. Then we're going to combine the narrative and high frequency information to approximate that the 2021 deficits explain maybe 30% of inflation over this period. We'll argue that loose monetary policy is important in the sense that short-term nominal interest rates were unchanged after the runoff. And finally, we'll find that a simple heterogeneous age and new Keynesian model does a pretty good job of matching the data, in part because loose monetary policy is important. Quickly in the data, we're going to study intraday risk-neutral inflation expectations from swaps. As you know, swaps are contracting on future inflation. Of course, swaps also embed an inflation risk premium that's stable over this period. So I want you to think about the swap prices that I'll show you as markets' expectations of inflation. And then we'll also have new hand-collected narrative data from investment banks. These data are pretty cool. We haven't seen them used before. What happens is that investment banks like Goldman Sachs or other macro research groups like Bloomberg or Moody's, they produce reports around market-moving events. They distribute them to market participants. They're time-stamped. They have rich narrative detail. And so they're going to be a great proxy for markets' beliefs, with lots of information that we can read to figure out what markets think is going to happen. In terms of the paper, I'm going to start by estimating the shock from narrative methods. So let me tell you about that. So just remind you of the events. In March 2020, there was the CARES Act at 2.2 trillion or 10.3% of GDP. Most of the paper is not going to be about this, but I just wanted to kind of remind you of it to send to what we do talk about, which is that in November 2020, Biden was elected. The Democrats had 48 Senate seats. There were 2 Georgia Senate seats to be decided on January 5th. The Georgia runoff was pivotal for deficit because if Democrats were to win, they'd be able to pass fiscal legislation without Republican support, but it wouldn't be pivotal for non-fiscal legislation. In the US, non-fiscal legislation requires 60 votes in the Senate. That would be out of reach no matter what happened. Georgia. In December 2020, there was the bipartisan stimulus worth $900 billion or 4.2% of GDP. There was the Georgia runoff itself. On January 5th, there was election day. On January 6th in the afternoon, there was the Capitol Hill riot, a potential confounder. On January 7th, both Democrats were declared victors. In the event, there were 2 pieces of Democrat legislation. In March 2021, the American Rescue Plan was a 1.8 trillion or 8.4% of GDP stimulus. And then a year later, there was an approximately deficit-neutral infrastructure bill called the Inflation Reduction Act. Then we're going to try and measure a narrative, measure the shock to news about deficits from the Georgia runoff. And if you think it's not so straightforward how you might measure this. So if you just cracked open a newspaper like the Wall Street Journal, afterwards they might tell you what they think Democrats are going to do. But what we need is something more. We need to understand counterfactually if either Democrats or Republicans were to win, what would happen in either case. Only then can we measure the amount of news released when we go from some chance of either party winning to Democrats winning for sure. Fortunately, this is exactly what the investment banks contain. So what we need is to read from the investment bank reports the expected stimulus if Democrats win, the probability of Democrat victory, and the expected stimulus with divided government. When we read all these, we find that markets think if Democrats win, they'll spend $900 billion. The probability of Democrat victory is 50%. And if Republicans win, then no more stimulus is going to get passed. That comes to going from a 50% chance to an 100% chance of $450 billion of fiscal news. That's a shock to fiscal news of about 2% of GDP. Markets think the stimulus is going to be deficit financed, mostly transfers. And additionally, they think the main other policy that's going to be a consequence of Democrat victory is delayed in tax-financed infrastructure, which quantitatively isn't going to be very important. Markets don't really think, and this is a bunch we do in the paper, they don't really think Democrats are going to be passing other inflationary policies like regulations or that kind of thing. So that's a narrative shock, 2.1% of GDP. And then we're going to look at the high-frequency response from asset prices. To belabor the point from the introduction, why look at asset prices? Because it's going to eliminate lower frequency emitted variables. If we look at the high-frequency response of inflation expectations from swaps, other shocks that might matter at like a monthly or annual frequency, like oil shocks, post-pandemic bottlenecks, and so on, they aren't going to matter at high frequency and confound our estimates unless news about them coincides with a narrow window around the election victory. So to estimate the causal effect of the election on asset prices, we'll do a single event study. This is pretty standard from the corporate finance literature. We'll assume that the asset price, YT, before the event at time capital T, has a typical movement, epsilon. So that could be like normal movements in liquidity or risk premium. Then after the event, it's the sum of epsilon t plus alpha t. Alpha t is the causal effect of the election itself. Our estimated causal effect, alpha hat capital T plus J, is simply the actual asset price after the event, Y capital T plus J, minus the expectation just before the event of what the asset price would have been if the event hadn't come to pass. If, in this case, Democrats had won in Georgia. In practice, one estimates its expectation using an ARIMA constructed from just before the event and then iterated forward. The identification assumption is that the distribution of typical shocks to assets doesn't change from just before versus after the event. So we're saying there can't be other atypical shocks just after the Senate election. Other typical shocks are allowed, and in fact, we'll be able to construct a confidence interval for whether or not movements in asset prices after the event are typical or atypical. So then the key question for identification is how wide should the event window be? It needs to be wide enough to capture the full effect, but exclude confounding events. So if it's only an instant wide, then probably we're going to miss the full effects. And if it's a year wide, of course, we'll include confounders. To capture the full effect, we're going to study a window from the beginning of January 5th to the end of January 7th. That's because existing estimates, existing state-of-the-art estimates, say it's going to take a bit of time for inflation swaps to incorporate fundamental information. The main potential confounder is the January 6th Capitol Hill riots. So in terms of robustness, we'll end the event window before the riots start. We'll have a bunch of other robustness to come. Bloomberg has a daily roundup of all the important market-moving events, and there aren't other significant events until a payroll release on January 8th. So this is the main empirical result of the paper. It's pretty simple. What am I plotting here? I'm plotting the percentage point increase in the price level expected over the next 2 years. Take the 2-year inflation swap, multiply it by 2. That's what you have here. So it's intradaily data. That's why it's jagged and dashed lines on weekends and public holidays. We're normalizing it so that its value at the start of our event window on the first observation of January 5th is equal to 0. Then we can calculate our estimate of what would have happened if the event hadn't come to pass. That's this green line, which comes from an ARIMA forecast over this period, iterated forward, with the confidence intervals that you can see in gray. Here's what actually happened to asset prices. There's a very big jump, and then asset prices remain high afterwards. Okay, the final thing is you can estimate the causal effects. So the estimate at the close of January 7th is this number here, minus the green line here, that's 40 basis points. 3 things to notice about this graph. Of course, the first is that there's a big jump right around the election. That's consistent with the causal effect. Second, asset prices remain high afterwards, so it doesn't look like some temporary market dislocation. It seems like something much more persistent. And finally, there's maybe a very small pre-trend before, but it's clearly not confounding the results. We've got a bunch more in the paper to study this. The main other additional empirical result is that according to dividend futures markets and investment bank reports, this is associated with positive real growth. So it seems to be like a classic inflationary demand shock. All right, so that's the high frequency response, 40 basis points over 2 years. Now I'm going to combine these 2 pieces of evidence to figure out the effects of the total deficits on fiscal stimulus. So the way I do this is I calculate an inflation multiplier. Take the price level response of 40 basis points, I divide it by the narrative shock of 2% of GDP to get a response at the price level of 18 basis points over 2 years. Now, one other thing I've done here is I've got an expectations, because that's where my sharp evidence is, about the expected response at the price level. And then here I'm saying, well, let me look at the response to the actual price level over the next 2 years. And of course, this is a bit more of an assumption, because what I'm really assuming is that the response of inflation forecasted deficits is approximately an unbiased estimate of the response of actual inflation to deficits, because I want to go from making a statement about inflation expectations where I have this sharp causal evidence to a statement about actual inflation where I have less sharp evidence. So that's one thing to bear in mind as a potential limitation. We have some evidence in the paper suggesting this isn't a crazy assumption, though. Taking this inflation multiplier seriously, we can extrapolate to figure out the effect of the 2021 deficits on inflation. We take 13% of GDP, multiply by the 18 basis points inflation multiplier. One ends with a price level, or excuse me, one ends up with a price level response of 2.3% of GDP, of 2.3% over 21 to 22. That's about 30% of the 2021 to 2022 inflation, suggesting deficits were pretty important. Also not the only cause of inflation. If one adds in the CARES Act as well and applies the same inflation multiplier, one gets to about 50% of 21 to 22 inflation. Finally, loose monetary policy seems to be important. This is the final empirical result. Short-term rates were unchanged. That's what you can see in this graph here. I'm just plotting the 1-year nominal bond rate. And you can see that from just before versus just after the election, the nominal bond rate doesn't change. In real terms, short-term interest rates fell, and that's consistent with loose monetary policy. Great. So the final exercise we do in the paper is we just ask, can standard models match the inflation multiplier? That's useful for 2 reasons. Firstly, because arguably this is exactly what standard models are supposed to answer, the link between deficits and inflation. So this is a useful event to confront them with. And secondly, it's also going to be a little bit more precise about what exactly this reduced form estimate and this reduced form experiment is supposed to capture. And we'll study an extremely simple heterogeneous agent New Keynesian model. I'll sprint through it. There's a fraction mu of hand-to-mouth households. They're consuming, their consumption CHT depends on their payroll after deducting lump sum taxes. Lump sum taxes could be negative. That would mean they are tax rebates. And they're in orange because orange will connote parameters controlled by the government. There's a remaining fraction, 1 minus mu, of overlapping generation households with survival probability 5. They're going to maximize consumption and savings to maximize the expected present value of utility, discounting by not only the factor beta, but by also their death probability 5. And they have isoelastic preferences over consumption and labor supply. They've got a normal budget constraint, which says the sum of consumption and assets has to equal the rate of return on past assets plus payroll after deducting lump sum taxes. Again, the nominal interest rate and the lump sum tax is controlled by the government. There's market clearing with consumption with output equaling the sum of consumption and government purchases. Finally, there's a normal sticky wages Phillips curve. I've got this set up with hand-to-mouth and OLG households to model a departure from Ricardian equivalence, an approximation to a richer heterogeneous agent New Keynesian model. In terms of policy, the government's going to set the interest rate, lump sum taxes, and government spending in order to satisfy the budget constraint. We'll do a standard calibration to pre-2020 data. We'll calibrate the consumption block to target marginal propensities to consume from the data, a flat but positively sloped Phillips curve. And in the model, what we're going to do is we're going to evaluate the inflation response implied by the model to the deficit bundle, the combination of structural shocks that's realized around the Georgia runoff. We'll then compare to the estimated inflation response. So we'll say if we take the model, feed in deficit shocks from the data, is it going to respond with the kind of inflation that we saw in the data? So we do a bunch. Turns out that one can sort of get a good sense of what are the structural shocks from reading the high frequency narrative information. So we read the path of nominal interest rates, lump sum taxes, and government spending from the narrative reports. We read the timing of government spending, which is very important, from the realized path of spending of the American Rescue Plan. We look at the path of debt repayment from how long-term interest rates behave. We feed in nominal interest rate shocks from the high-frequency responsive interest rates, and we assume the economy is in steady state after 10 years. So these are the shocks that we feed into the model. On the left-hand side is the path of fiscal stimulus. So in blue is how transfers are expected to respond due to the innovations of the Georgia shock, 2021, 2023, and so on. And orange is how government spending is supposed to respond after the Georgia shock. On the right-hand side is monetary policy, how interest rates are expected to change in nominal terms. So at the short end, nominal interest rates don't rise at all. In the long end, nominal interest rates rise by a lot. What happens to inflation? This is the middle panel. So basically, the simple Hank model does a good job of matching the data. In blue, here's what happens when we feed in the shocks realized around the Georgia runoff. The model says this is what we expect to happen to inflation in 2021, 23, 27, and so on. In the data, in orange, is what markets think is going to happen to inflation. Inflation's meant to go up by a similar amount to the model. One can take two things away from this. Either the model passes the quote-unquote market test, in the sense that markets and the model agree about what's going to happen. Or you might think if the market's capturing some feature of the world, then the Hank model has passed that barrier too. Great. In the paper, we find that a key mechanism for the inflation response is loose monetary policy, but now I'm going to wrap up. In this paper, we've come up with a high-frequency narrative approach to figure out the causal effect of deficits and inflation. With this approach, we're finding that the December 20 and March 21 stimulus explained an intermediate share of inflation over this period. Deficits were important for inflation, but not the only cause. And as a closing thought, we hope this high-frequency narrative approach could be useful for estimating other causal effects from single episode-specific shocks. Often influential episodes take this form. Thanks a lot.
Okay, great. Thank you. And for people in the audience, if you have any questions, feel free to type them into the Q&A box, and I'll start fielding some questions that we have already to the presenters. The first question is for Professor Nagel. What is the scope of where this learning from inflation applies? I guess that this doesn't apply in hyperinflation scenarios where inflation can rise or stop extremely rapidly.
Indeed. So this is what I meant to say with my comment at the end about, Salchin's famous paper on the end of hyperinflations, that once you have drastic regime changes, of course, then expectations can be reset. So I think of this more as explaining what's happening in a world where there's no drastic regime change of that kind.
Okay. A question for Professor Hagel is, was there an expectation of deficits due to tax cuts more likely under our control than a decontrolled Senate? Maybe there could have been some sort of a deal worked out. Is this possibly an omitted variable that could be relevant?
It's a great question. So we were exactly worried about something like this, or more generally, other differences in policies between Democrats and Republicans that could have raised inflation. And so what we do in the paper is we go back and we read all of the reports, both with the human and ChatGPT, to say what are the likely outcomes of victory. We classify these into topics. And basically, in terms of topics, what seems to matter is that Democrats are going to do stimulus and they're going to do infrastructure spending. Other stuff seems to be fairly unimportant according to the markets, with the slight exception of Federal Reserve appointments. And obviously, we have some stuff on monetary policy too. So definitely a concern in principle, but in practice, it doesn't seem to be too important.
Okay. A question for Professor Nagel is, how do you think about the updating of inflation beliefs by firms and markets who might not be quite as behavioral? In terms of the model, should the central bank optimally weight all types of agents?
Yeah, I guess the first thing I will say about this is that, I guess several things. So if you look at professional forecasters' expectations for long-term inflation, they are not that different from the way they look like for consumers. So there's not, in terms of these secular dynamics we are talking about, there's not a big difference really. And the second point I would say is that what matters most is the expectations of the price setters. And that's, to some degree, a little bit an open question. Should we think of these price setters behaving more like consumers or like super sophisticated people? Well, I would probably argue they're maybe not that different from consumers in a typical firm. And the third point I would make is that Ulrike and I, in an earlier paper, we actually looked at members of the FOMC, which are probably the most, technocratically sophisticated people, or among those out there, with lots of supports from staff at the Fed. And even there, you find experience effects in their inflation expectations. So I wouldn't say that professionals that are highly trained are necessarily immune to these experience effects.
Thank you. We have another question for Professor Hazell. Let's see. The narrative measure is really cool. How thick does the set of sources have to be to capture the main information factor? Given that we only have 20, or you only have 20, how about other financial expert reports, which could be noise, but maybe could also influence agents' behaviors?
Great question. So we'd love to have many more than 20 reports. We think we're roughly restricted to the 20 for the following reason, which is that it's relatively uncommon for reports by financial market participants to describe in advance of the event that's going to come to pass what might happen under the different scenarios. So that's sort of where the investment banks shine, because they do this kind of scenario analysis where they say in advance of the event what they think is going to happen. Ideally, we'd have hundreds of these. Our sense is that other kinds of analysts just don't commit to this specific information on paper. So looking hard through the Financial Times, the Wall Street Journal, Bloomberg News, not Bloomberg Economics, the consultancy, typically what they say something like, oh, we think Democrats are going to spend more than Republicans and they're quite likely to win. And obviously that's not usable quantitative information, whereas the investment banks do commit to this. So ideally we'd have 100, but we only have 20 for that reason. And I think it's one of the big asterisks about the paper is how seriously do you take these 20 investment banks? A related concern is that the banks are hopefully a good proxy for the market, but they might not be a perfect proxy for the market. The banks in the market might disagree.
Okay. Thank you. I have a question for Professor Nagel, which is that the learning model, I think you developed it in 2016. But when I kind of think about the recent bout of inflation, it seems like there was a lot more uncertainty about what the true beta was, the persistence of inflation and the magnitude of inflation shocks rather than the long run rate of inflation. I guess how do you think of your learning from experiences model applying to maybe a case where people don't know how persistent the inflation shocks are?
I guess that's in our model that's incorporated in the sense that people are trying to figure out what the persistence is, and they learn about this from data that they see, right? So I abstracted from the persistence aspect in this presentation here because I'm in that model just focusing on long-term inflation expectations. But that model that we developed, this learning approach, takes this into account, and it is indeed a problem that people have. Persistence used to be high in the 70s, then it came down. Did it go up again now? Well, how do you find out? You try to figure it out from data. That's sort of how it works in that framework.
I guess I have one last question for Professor Hazell, which is, I guess, could you elaborate a little bit on these investment bank reports, and if they're just kind of putting them out there, do we think that these represent the best information that these investment banks have given, or they're presumably not, sounds like they're not charging for access to them. So I guess my question is, do these represent their unbiased beliefs, or are they maybe keeping a richer set of information for themselves?
Right. No, exactly. So the model that operates here is that if you're a market participant and you trade an investment bank, then they will give you the research for free. So it's a loss leader of sorts. At least this is true in the US. In the EU, there's more of a fee for service. It's a huge concern. I think if the biggest concerns of this paper, I would say is probably that. So I sort of have this I guess the outcome, I had the shock and the response. And for this multiplier exercise, it's important to get both the shock and the response right, so you can scale up and scale down the total effects of deficits. I think, I'm reasonably confident in how the response of inflation expectations evolve, but with the shock, less confident. Now, I will say that within the sample of 20, in terms of the actors, most of them are investment banks. but maybe 3 or 4 of them are non-investment banks. So Moody's Economics, Bloomberg Economics, a couple that aren't investment banks. They cluster in the same place that the investment banks do, which is about 900 to $1 trillion. It's not obvious why they would have an incentive to sort of hide that and sort of say a number systematically different from what they believe. And the data doesn't seem to support that, but at a high level, it's absolutely a concern limitation of the data. That said, I do think the data are very cool and very underrated and sort of pretty easy to access. I think it's something economists should try to teach more.
Great, thank you. I think that's all the time we have for questions and for the seminar. I would like to thank the 2 presenters for talking about their papers today, and I would also like to thank everyone in the audience for attending.
Thanks for having me.
Thank
It was
you.
great.
Thank you both.
Well,
Yeah, thank you so
take
much
care.
for
Thanks,
talking
Raphael.
about.
Thanks, Really enjoyed it. All right, have a good day, everyone. Bye.
Thank you. Bye.